Welcome to Financial Discretion Advised. I'm Tyler Hafford, bringing back a fan favorite, Craig Johnkiss, one of the managing partners here at PFA, for our discussion today. Craig, how you doing?
I'm doing good, Tyler. How you doing?
Good. We were just talking about the last time you were on. You broke the recording software.
I know. I'm hoping for better results today.
Gonna try to get through this in one take. But I want to bring Craig on today. Market obviously been slumping, and unlike my golf handicap, just keeps to continuing to go a little bit lower. And we want to have a podcast on what should we be doing? How do we take advantage of market downturns like this? Because there is a silver lining in everything, and in the market right now, I think there are some opportunities folks can be taking advantage of. So where are things at? Let's talk about the market right now in general. We've entered this bear market. You've been in the industry a few times. You've seen a couple bear markets along the way. What are you seeing from client sentiment right now? Are we hitting a point where people are getting just uncomfortable with what's going on?
Yeah, absolutely. You know, we sent out a client letter a couple of weeks ago because we get to these places where, you just know your clients are feeling the anxiety.
Yeah.
The market has been not only down, but lingering that way for a while.
Yeah.
We seem to have a couple of, little recoveries where you think maybe we're getting to the other side of this thing. But the reality is we're 6 months in.
Yeah.
And that's actually one of the longer down markets that I've experienced in a while. We've been, really spoiled and fortunate that a lot of our down markets have been pretty quick.
Yeah.
Some of our clients don't even notice them sometimes if they're not watching closely enough.
Right.
So.
And kind of a sharp contrast to what we saw in 2020, right? We saw this big drawdown market. I think got down to lows of 40% or something like that. And then really quick recovery. A lot of that sped up by the Fed just pumping money into the system. But I think behaviorally much easier for investors to kind of digest that when 6 months later you're back to normal valuations and you're kind of moving higher. Like you said, trudging along, it feels like every week we have just some bad news that kind of sends us a little bit further.
And that pandemic was unique.
Right.
We had never experienced it before, but I think we have a lot of people right now that have experienced inflation.
Yep.
They've been through the 70s and 80s, and they know what this looks and feels like.
Yeah.
And it hurts their wallet every day in addition to their investment. So this one, I think, just has some heightened fear around it for sure.
And I'm going to take this for a quick plug. And I know I bring this up in a lot of podcasts, and I know you work with on clients because we work on it with all our clients here at PFA, is figure out your risk tolerance and your risk capacity, right? Your risk tolerance, again, your ability to stomach this type of volatility, your risk capacity, your plan's ability to withstand if the market's going up or down, right? When we look at building out financial plans for folks, we want to build a plan where they don't have to care what's going on in the market.
Right.
So their risk capacity can handle this type of stuff. I really think it's important for investors to kind of pay attention to that. But let's say, all right, market's down in bear market territory. How can we take advantage of this? Someone sitting in cash today, got extra cash on the sidelines. What are we doing? What do you think our strategy should be there?
Yeah, good question. I think a couple of potential strategies that come out of that, one more opportunistic than the other, one a little bit more risk managed, but I'll talk about the first. I think it's appropriate to look at this and say, this is a really good discount to stock prices. I'm a long-term investor, and I'd like to enter this market here. When I've been talking with clients lately, that would be my approach. I think the market's down, 20, 23%. Different parts of the market are down 30, 35%.
Right.
There are some good buys out there.
Yeah.
If we fast forward the clock to 3, 4, or 5 years from now, I think we look backwards on this and say, I got in there. That was a really good place. I'm not one to get too greedy about finding the absolute bottom. I like to deal in known quantities. Here we are down. I'd be willing to take that discount and just start piling money into the market.
Yeah. I think that's extremely spot on, right? If we look at the market and we put it on the wall away from us and we stood 15 feet away, we're going to see that nice trend up, right? If we stand 1 or 2 feet away, we're going to see a lot of choppiness. And this is one of those moments, right, where we may have more down. You might get some money in there. The market slides a little bit further. But if we are looking on that long-term trend, if we are long-term investors, I really think these entry points are going to look really good down the road, like you mentioned. So
Agreed.
Getting some money in, I think it's important for folks that are a little bit more risk adverse. Let's say they don't want to get all their cash in. what kind of strategy can we use to start taking bites of the apple?
Yeah. Yeah. And this is my more common conversation right now, is taking bites of that apple. And that's what we call a dollar cost averaging plan at the end of the day, or a DCA plan. So, committing to the market's down, let's get a little bit of our cash in the market.
Yep.
And then let's set up a routine, systematic schedule of buying over the coming months. For a lot of our clients, I think I've been doing that over like a 6 to 12 month timeline, depending on the risk tolerance of the investor. This is a really good tool. I think what people need to remember is all it is a risk management tool.
Right.
All it does is diversify your entry points so that not all of your money is going in at one buying point.
Yeah.
It's not because we're predicting the market and we're saying there's going to be lower points to buy. We don't know. The DCA might work. The market might continue downward and we get lower entry points. The market might come back up, in which case we should have just put all our money in at once. But this is a risk management tool, spreading out your buying, not being susceptible to the day you're buying.
Right. And like you said, risk management, you can put all your money in the market today. If it goes up 10%, you got in, all your money benefited from that 10%, right?
Right.
But this plan is giving you some protection that you put your money in and it doesn't drop 10% and you lose 10% of value immediately. So it is giving you kind of a bit of a risk management of getting into the market. I also think that it gives you a lot of flexibility, right? So you may come up with a strategy where you say, we're going to do 10% over the next 10 months of getting our cash in the market. But let's say something really changes and the market takes a plunge of 20%. Well, now you have some cash on the sidelines where you say, I really like this entry point. Now we're down, 40%. Why don't we get a little bit more in right now and take advantage of more and more of those dips? So I do like the flexibility that plan gives you. It doesn't necessarily have to be as rigid as if you set it up.
That routine schedule. Actually, just did that this week with a client, and he had a really good term for it. He called it the ripcord, and I love that. So now, now I'm going to start calling it the ripcord with people. If we just get to that certain bottom, it just looks like too good of an opportunity to be true. Pull that ripcord, and we can put it all in then.
It's funny. This is the only industry where when things go on sale, people kind of run out of the store screaming. Being ready to take advantage of those opportunities, I think is good. And if you have cash on the sidelines, these are certainly the opportunities you want to take advantage of.
Definitely.
Let's say we're in our investments. We don't have cash on the sidelines. What should we be doing to kind of mitigate or pay attention to volatility to best set us up for long-term success?
Yeah. So I think one of the routine things that should be happening in your portfolio at this time is some rebalancing. Rebalance is an important part of investing, no matter the market that you are in. But especially when things are volatile, it can be, a little bit opportunistic in your portfolio. If equities have lost value, that become a smaller portion of your portfolio. You do some rebalancing, you pick up some more equities at cheaper prices. So when we do come out of this thing, which will happen, we'll come out of it and be better on the other side because our asset allocation's intact.
Yeah, I think that's a really big one for investors because we see it a lot, especially in folks who aren't working with the money, someone managing the money, where their equity position takes this huge hit as stocks slide. We see the recovery, and what used to be a 60-40 portfolio is really now a 40-60 portfolio because the equity position is so low, and they have a slower recovery because they're not really lined up with what they thought they had for risk.
Exactly.
Yeah, so really important. So we're rebalancing, but there are some types of investments we can be making that do well in these types of environments, or at least give us a little bit of a hedge against the stock market kind of sliding. Right?
Yeah, absolutely. So, these are types of investments that I think you've got to, have a watchful eye on and pay attention. They're not quite a set it and forget it, but I think considering alternative assets in the portfolio right now makes a lot of sense. We've had an over allocation to alternatives since early in the year. It's treated us pretty well. Those are things like a commodities basket. So having some participation in inflation and having that benefit you rather than, suffer from the effects of it can be really valuable. And they're assets that add diversification to a portfolio. So they act a little differently than your traditional stocks and bonds. So considering allocation there makes a lot of sense, but some of those we need to know too, if we slip into a recession, they might turn the other direction and not act, so well in the portfolio. So they do require some monitoring, but I think, can provide some defensive strategies for people.
Yeah, and Sam and I have done a couple podcasts on alternatives. So if anyone wants more information on this, go back and listen to why we think it's important. I think moving forward, it's always going to be important to have some type of alternative sleeve to your portfolio. I think, like you said, some things are going to benefit really well right now, but may not if we slip into recessionary times or if inflation comes backwards or if rates come down at some point, right?
Yep.
All of those things could change what type of alternatives you're holding, but I think having some of your money invested in alternatives is extremely important.
Yeah.
You can also kind of look at defensive sectors, right? Things that do well if you think we're stepping into a recession. And there are a lot of boxes being checked to say that the risk for a recession is increasing.
Right.
Are we in it right now? Are we going to be in one soon? Time will tell, but making sure you're invested in the right places during those periods of time can be important. So things like utilities can do well during recession, right? People are going to pay to keep the lights on.
Right. Healthcare
Can be a good one. On the flip side of that, a lot of your growth companies are probably going to be the losers through that period of time, right? There's not going to be a lot of capital expenditure. Those companies that are built on the promise of future earnings don't look all that good when recession's happening. So certainly taking a look at your investments. And there's another thing going on right now that people can take advantage of, but we shouldn't sell out of the market to take advantage of this, right? And it's actual raising interest rates. Well, it's going to make borrowing money a lot more expensive. There are some advantages, right, for folks on the savings side.
Yeah, absolutely. For the first time in a long time, we're seeing some pretty good interest rates for people who are depositors and just don't have an appetite for stocks. We saw it very, very briefly in 2018. There were, the Fed was going through a rising rate policy then for a short period of time, and we saw some decent interest rates, but it was short-lived, maybe like 3 months. And here we are in this environment where we're rates are going up, and we're pretty sure the Fed's going to continue to increase their benchmark rate for a while. There are some good interest rates out there. So whether it's a bank CD or a fixed annuity, as long as you're not getting sold something with a lot of features that you're paying for, we can find things out there right now earning 4% guaranteed, no risk, some liquidity along the way. So for those who aren't willing to get into the market, that could be a good option too, but definitely not a good option to be taking losses and running to something like that.
Right. Yeah. You don't want to kind of sell out of a stock portfolio that's down 15-20% right now and buy something or put it in something that's going to make you 3% or 4%.
Take you 4 or 5 years just to get back to where you were. And with inflation along the way, you've still lost purchasing power.
You're way down. And it actually kind of gets into the next topic I want to talk about is a lot of folks are looking at the market right now saying, I turn on CNBC, everything is losing money. Everything is losing money. Why would I even want to get involved in this? It's all doom and gloom, right? You keep telling me there's going to be recovery, Craig. I don't know if there's going to be recovery. There are some fundamentals that the market has shown us over time on how these things behave. Now, every bear market tends to be a little different. But the outcome is always the same, right? We always recover. It has, and every time we've had a crash. But what are some of these fundamentals that we should be paying attention to just remind us that getting money into the market's a good idea, especially in the long term?
I think you nailed number one right off the bat, which is track record. The stock market has a 100% track record of recovering from economic turmoil and recessions and bear markets. So number one, just keep that in mind. But then some of the fundamentals, I think, even if this is a recession, if we look at kind of average recession level losses, I think those typically circle around like the 30% mark. So not too long ago, our market was down just about 25%. That's within 5% of an average recession's low point. That's why I look at that in the purview of what a good opportunity. Yes, some recessions are worse. Some are also not quite so bad, but that's a good measuring stick for where we were. And also timeline of that bear market too. I think most bear markets are about, an 18-month cycle when we go into recession.
Yeah.
We're already 6 months into this one.
Yeah.
So, I think we can use those just as some guideposts along the way.
Yeah, some reminders. And I know, I like looking at those statistics. When we talk recession, 08 just comes to mind, right? That's emotionally attached to a lot of folks. That was a really tough recession. And a lot of people got hurt through that. So that's kind of what we go to. 08 is kind of the exception to the rule, right? That was unusually long. It was unusually deep. Not necessarily what we normally see in a bear market.
Right.
So while it does look like doom and gloom, I think if we look at 08 as being the exception, not the rule, we start to line up with this is what a bear market looks like, and this is typical levels of what we hit and come out of it. I think there's another big thing here where time in the market is always going to beat timing the market. You're never going to find the bottoms. You're never going to know the tops. And understanding that the market is a leading indicator, right? So the market right now is trying to price in what it thinks is going to happen in the economy.
Right.
So it thinks, all right, there's a good chance we might step into a recession. It's trying to price that correctly. And then when we're coming out of it, it's trying to price, this is what the recovery is going to look like. The reason why it's so difficult to time that is if you're making decisions in real time on your investments and the market's looking 6, 8, 10 months out, you're behind the curve, right? You're not going to get it right. So everyone who gets into a recession decides they want to get more conservative. They start selling out of stocks. They start doing that. The end of the recession is actually the best time to be getting into stocks, right?
Exactly.
That's when we kind of ride it back up.
When you're turning on the news every day and everything is bleak, when you can barely find a reason for why you'd ever want to be a stock investor,
yes,
that is going to be the time that you want your money in and that we're going to turn the corner.
Right.
Our market will be recovering while everything in the real world will still feel bad. Yeah.
Yep.
Absolutely.
And that's and we're seeing that right now, right, Craig? So everything in the real world doesn't, I mean, inflation's high, but we're still seeing job growth. We're seeing wage growth. We're seeing healthy savings levels of Americans. Probably getting a little cracked right now as we're doing this.
Yeah.
But everything doesn't seem like doom and gloom in the real world. Market makes it seem like it's significantly worse.
Exactly.
Right.
And we're just starting to see a little bit of turnover in some of those indicators.
Right.
And that just shows you the predictive power of the markets. The market started this 6 months ago.
Right.
And we're just starting to see the signs of it in the real economy today.
Yep.
And it will be the same on the other side.
Yep. So, I think remembering those fundamentals, getting the money in the market, if you're a long-term investor, is always going to be the best play.
Yep.
Because over time, we've known that the market just goes up. There's just going to be a lot of kind of bouncing around. But along with those fundamentals, we need to kind of tackle this emotionally, right? Because it is our money. We take a look at it. Craig and I help folks manage their money. We can take an objective view of it, but we're human too. I mean, I don't like checking my bank account or my accounts when the market's doing what it's doing, but I have to emotionally handle that. And certainly in our jobs, we help people emotionally handle that. But do we have some ideas or tips for folks to kind of navigate these waters?
Yeah. And everyone is a little different emotionally too. So people are going to have different emotional strategies for dealing with it. One that might sound like a bad idea, but I think is a really good idea is just stop obsessing over checking it every day.
Yeah.
Turn the news off. Stop watching things. Don't check your account balance every single day.
Yeah.
Take a break from it all and just go about living your life. Enjoy the things that you have and that are in front of you. Be present and don't worry about what's going on. I think, when things are good, it's a lot easier for people to do that.
Right.
But it should be the same through the downside. These are things that change in value every day. And by the very nature of that, they create fear.
Yeah.
And, you can remove a little bit of that fear by just not obsessing over it.
Yeah. And I like to think of it like your house value, right? You own these assets, they go up and down in value. Right. Your house has a value. If you lost 10% tomorrow in your home, one, you probably wouldn't even know it. Exactly. And two, if you weren't selling tomorrow, you probably wouldn't care. Buying a home in the United States has proved to be one of the largest wealth builders that anyone can do. And over time, that asset will benefit you down the road. Same thing here, right? If the account loses 10% of the value, the problem is we can log in every day and put a number value to it, and that emotionally causes a reaction into us. the house value, not necessarily the same. Like I said, you probably wouldn't even know. So I like your idea of just set it away for a second,
Right.
put it down, walk away. We know over the long term, this is going to be the best place for your money. And just let it do its thing, because if you just obsess every single day, you're going to make a bad decision at the wrong time.
Right.
And that's when they do. And like you said, capitulation is the word that you keep hearing in the news, but essentially what that is they want a point where everyone's looking at the stock market and the last thing you want to do is buy stocks. Right. That's the moment they're looking for. And emotionally, that's what you have to overcome when you're looking at your account every day is you're going to hit that point where you're going to say, I just don't want to see this go down anymore.
Yeah.
And you make a bad decision at the wrong time. So,
yeah, absolutely. Other people too, just to share another one,
yeah,
I think need a little bit more like coaching or evidence to get over their emotions. So I'd say also, if you've got an advisor, or even if you have a family member or a friend that can serve as like somebody to just bounce your, anxiety off of, do that. Pick up the phone and call. Right now we're encouraging conversations with our clients because we can look at their financial plan, remind them that we have simulated events like this, and that their financial plan is still on track, even if events like this occur.
Yeah.
And so to be able to talk with somebody, kind of get rid of some of that emotion, show them the evidence of we've planned for this and we're going to be okay.
Yeah.
That can help kind of alleviate some of those emotions too. So I encourage everyone to reach out to somebody.
Yeah, absolutely. To be honest with you, I am a firm believer that I can add the most value to someone in moments like this when I'm working with them.
Yeah.
If I can help them make just avoid making the bad decision right now, the benefit 5-6 years down the road is enormous, right? We talked about that. So yeah, it's certainly reach out, talk to folks. And I like the planning aspect that you bring up too, because when everything seems like doom and gloom, throwing that planning software up there, seeing that probability of success, seeing that I'm still on track to hit my goals, that can be that silver lining, that light in the dark that kind of gets you through these moments. So all right. So I wanted to just wrap up with a few strategy points of folks that folks can take advantage of here while the market is down. Let's start with Roth conversions. I know we've done a pod completely on Roth conversions.
Yeah.
But what are you looking at here? Why is now a good time to start exploring a Roth conversion?
Yeah, so in normal times, we do most of our Roth conversions at year end because we like a lot of the other tax data to be a sure thing for the year. Right. So we kind of do it towards the end of the year when our conversions can be calculated most efficiently. But in a year like this, where the market drops quite a bit, this is an opportunity for you to take money that has lost value, convert it, and then experience that growth cycle all tax-free. Yeah. So if we can convert while the market's down, we're essentially just kind of leveraging a pool of money that used to be bigger into a better tax-free environment. We're going to experience all that growth tax-free. Yeah. Really good time to be doing it. So, even if the calculations can't be perfect, doing partial Roth conversions or getting close right now is a really good idea.
Yep. Yeah. Really good kind of way to set yourself up for that long-term growth, right? Especially if you've wanted to have more tax-free assets, you've been limited by your contribution limits into the Roth. The market's giving you kind of an entry point right now. Say, all right,
exactly,
get some of that money in there. You also brought up a really interesting one before the podcast that you've been talking to folks about, and that's 529 contributions.
Yeah, again, a tax-free location. So I love taking advantage of bear markets in tax-free accounts. Yeah, because we know historically that our best growth cycles occur after bear markets and recessions. Yeah. So we can get the most tax-free growth. So 529 plans, way to save for college, sock away money tax-free. A lot of my clients do routine contributions to those, either systematically or lump sums. Yep. And I've been just encouraging my clients to step those up and make larger contributions while the market's down. Again, so when growth does become explosive again, we're getting that all tax-free for a specific purpose. Yeah. And there's a place where, you've got a determined time frame. You know how old your kid is? When they're going to college, if they're going to college. Yeah. So if you've got a 4-year-old at home and you've got 14 years, hey, you don't have to worry about the next 2 or 3. Yeah. This is a determined time frame. Why not get some money in while we've got a good, entry point?
Yeah, I love that. And like you said, there's in Maine, there's a number of incentives as well to kind of use their plans. There's a lot of matching grants out there and all that.
Yeah.
So yeah, any extra money sitting around, if you know the kid's going to go to school down the road, you know it's going to be expensive. Good time to kind of start investing for that.
Yep.
And then the last one I have here is just tax loss harvesting.
Yeah.
Right now we're taking losses in portfolios. It is a good time to offset some future gains by taking on those losses and reallocating, especially if you haven't rebalanced in a while. Might be a good opportunity to do that. But certainly the market's giving you an opportunity to lock some losses.
Yeah.
So,
Or if you've got a position in your portfolio you haven't liked for a while, but you've been hanging on to it because it's got big gains and you
Yeah.
don't want the tax hit, maybe take another look at that, establish asset allocation, in a better fashion by getting rid of that position.
Yeah.
Yeah.
I think I want to leave this with just a couple thoughts. One, don't stop investing during these periods of time, right? The market is scary. It seems like doom and gloom. We've said it in this podcast a number of times. The market has recovered from every single one of these. Don't stop investing. Right now is the best opportunity you have to get some money in the market. And if it goes lower, then that's even more of a discount to get your money in. But over the long term, it's gonna be a good thing. And that these downturns are measured in months and the up times are measured in years.
Right.
And that's why we invest. So, I hate to talk with someone who say, well, I just stopped my contributions. I really think right now is the time you want to be making those if you can.
Yeah,
So,
absolutely.
Any final thoughts?
No, I think you hit the nail on the head, man. I think everything else we talk about is the nitty gritty.
Yeah.
The most important thing right now is stay disciplined.
Yeah.
If you do that right, all these other little things, they amount to much less.
Yeah. Yep. Awesome. Well, Craig, thanks for coming on today. Anyone has questions or comments or wants to talk to us, our emails are on the website. Also comment below, like, share. Thanks for listening, guys.
All right.
The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Thank you.